of IFRS. A very good afternoon and warm welcome to ASSOCHAM Masterclass on Indian Accounting Standards. Friends, as we know that Indians are fully conversed with principles of IFRS, and generally there are the accounting problems or issues which result in material financial statement errors, undetected gaps, and frauds due to inadequate internal controls, misapplication of generally accepted accounting principles, regulatory non-compliance, and maybe the cybersecurity risks. Since the International Accounting Standard Board continuously revises and amends IFRS, therefore, the other important issue for mismatch in the statements could be like delay in keeping ourselves updated about Ind AS. Therefore, by inviting participation in such sessions, we strive to ensure the terminology and substance of disclosure of accounting policies being presented amongst the participating organizations are in fine-tuned and in an updated internal environment, and that can reflect true and fair recognition, measurement, and other requirements. Friends, you know, ASSOCHAM is the industry member representing on Accounting Standard Board of Institute of Chartered Accountants of India, and significantly contributing by way of providing inputs for Ind AS, field testing, or dry run of amended versions of accounting standards from time to time, as well as by way of conducting advocacy through the series of knowledge sessions, conference, and seminars. I trust some of the participants in this session attending today. They have also attended the conference recently held on 20th January, which was addressed by former Union Minister with 10 portfolios, Shri Suresh Prabhu, and we had Honorable Chief Guest NFRA Chairperson, and several eminent speakers and guests from industry and profession. They participated. Today, in continuation of that particular conference, we have set out two sessions, one that gives insight on Ind AS 115 and another gives insights on Ind AS 116. First, we have session on Ind AS 116 that pertains to accounting for leases. This sets out the principles for recognition, measurement, presentation, and disclosure of leases. The objective of Ind AS 116 is to ensure that lessees and lessors provide relevant information in a manner that faithfully represents those transactions. This information gives a basis for users of financial statements to assess the effect that leases have on financial position, financial performance, and cash flow statements of an entity. So how best you can comply to the accounting treatment, disclosure requirements of your respective organization with respect to Ind AS 116, we have very eminent speaker, faculty for this session, Ms. Sarika Gusain, partner Mazars in India. About Sarika, I would just like to briefly introduce you. Sarika heads the technical functions of the firm Mazars in India. She has almost 19 years of experience in the field of technical advisory, research, training, and servicing large clients in the area of audit, accounting, and corporate laws. She's a visiting faculty for ICAI India's course. She also leads the ESG and sustainability practice of the firm. She's a proactive member of ASSOCHAM Task Force on Accounting Standards, Sustainability Accounting, Integrated Financial Reporting, and has been representing to Bureau of Indian Standards. I invite participation of all of you and would request to make best use of our resource available today. Ms. Sarika Gusain, partner Mazars in India, and you may have few questions. So I may like to request you to please keep writing your questions in the chat box. We will try to address your questions by the faculty after the presentation. So I welcome and invite you, Sarika ji. I hand over the mic to you, and over to you, please.
Thank you so much for the warm welcome and the nice introduction about me. Though I do not have these many capabilities to be addressed in these many words, but still I would accept that address. Thank you so much. And again, thanking you for giving me an opportunity to share my views on my first baby, which is accounting, as I said. So in the recent session, what we had, the virtual session is today. So the physical one, which we had recently on 20th. So I had mentioned that my new baby is ESG and sustainability, and I'm giving due care to that, but it doesn't mean that I've left my previous baby, and I take care of that as well. And in that process, I am now sharing my views on a very important topic, which is lease, and why it has become important because I would not say recently, but few years back it got changed. ever since anybody must have started, studying accounts or the accountancy course, whatever they are doing, they had seen the lease accounting from a different angle altogether. But after the introduction of Ind AS 116, there is a sea change. And change is so because the accounting for lessor and lessee has changed significantly, and the mirror accounting, what we always used to see, is nowhere standing. So I would like to share a brief presentation as always. So without which, as per my personal belief, the session goes undirectional. So I would like to share my presentation here, that is on Ind AS 116. Just to give you brief, because I personally believe as a speaker that unless we know what is there in the kitty or in the bucket today, for me, my body language as a participant will not sync with the presentation. So I need to know what all take home is there for me as a participant or a speaker. So I would be discussing the previous and the revised position I was just talking about. What is the impact of the revised position per se, then lease recognition exemptions, what have been provided by the standard, then why does that change there, it happened, we will discuss briefly. What is the scope of the standard? So it's very important to understand the scope of the standard, because the basic concept, and if I have to travel, unless I board in the right plane, I will not reach to the right place. Therefore, to understand the scope of a particular standard is a must. We will be discussing that quickly. What is the lease definition and why I'm focusing on this? Because the lease definition has changed significantly, and therefore more leases will get placed in the financial statements of the company, and therefore it is imperative to understand the depth of the lease definition, which is quite wider as compared to the previous standard. Then we will be discussing composite lease as a concept quickly, and then how to measure the lease liability, which is a new concept. uh, how to measure the right of use asset, again this is absolutely a new concept. I'm sure now people have prepared their financial statements after 1st April 2019, therefore they may be aware, but if not, not a problem, we will discuss that. How the lesser accounting remains unchanged indirectly, and how it is changed indirectly, again we will discuss quickly. And last but not the least, we will quickly understand few differences which are majorly given as compared to IFRS 16, which is the mother standard for Ind AS 116. So let's get started. So let me tell you why this has changed. So once the past chairman of IASB was traveling in an airlines, and he thought that for years and years these aircrafts remain in the books of the lessor, while the lessee use these aircrafts for substantial period of time. So it is somehow misleading position wherein people are not showing their leased asset, specifically in case when it is an operating lease, in spite of the fact that they are meeting the definitional requirement of the standard, but still this is not the correct position, and therefore the thought emerged in his mind, and we have the revised standard in front of us. So while I'm saying previous means this standard 116 is also not new, but since we are accustomed to see finance lease and operating lease for the lessor and the lessee both, therefore previous means the position prior to the introduction of Ind AS 116. So the previous position, as I said, for non-Ind AS compliant companies, we were following, and we are following AS 19. For Ind AS compliant companies, we were following Ind AS 17, that largely had risk and reward model. There was a distinction between finance lease and operating lease, and that was applicable. Still it is applicable, but that was largely had a mirror accounting, and these two concepts were applicable equally for lessor and lessee. And now what has happened, uh, you know in the finance, uh, current means the previous position I'm talking here, in the finance lease, the asset used to find place, the leased asset in the balance sheet, and the liability was also there in the balance sheet. But in case of lessee, the operating lease never had assets and liabilities in the financial statements, and those were given as off balance sheet obligations. So that was the previous position prior to introduction of 116. What has changed after introduction of IFRS 16 or Ind AS 116? So IFRS 16 became applicable globally with effect from 1st January 2019, and therefore after 3 months period, Ind AS 116 also got implemented in India with effect from 1st April 19. So largely you would see that whatever IFRSs or revised IASs are applicable globally, they are largely following the calendar year. Therefore, they would largely be applicable from 1st January. And the replica of it, which is in the form of Ind AS, which we have to apply in India, would either be applicable from the same year, that means after 3 months, or after 15 months if it is applicable from next year. So largely, generally you will see after 3 months or 15 months, whatever the case may be. This standard got applicable with effect from 1st April 2019. And I remember those days. I think we had a physical seminar with ASSOCHAM, and lease was the newest concept, and we had done a lot of research internationally. We were struggling with certain concepts. We were not sure as to how these certain definitions would be interpreted, certain concepts would be interpreted. But now the things are largely stabilized, and we know industry practices. So even if certain guidances are not given in the standard, we have certain practices to be followed. What has changed? So largely what has changed is only for lessee, and that too control model has been brought in place of risk and reward model. For lesser accounting, the accounting remains unchanged, and therefore the lesser will continue to bifurcate the leased asset as finance lease or operating lease. But with the introduction of the control model for lessees and with the introduction of the lease definition, the lesser accounting will be impacted indirectly, as to how we will see. Then we will also understand how the lease accounting has changed. And as I said, it has significantly changed. There are certain reasons why it got changed. So as and when any IFRS is issued, there is a lot of deliberation. The exposure draft is issued, then the comments come back, and then those are incorporated. So it also got implemented in couple of phases. There was a trial to maintain parity with the US GAAP as well, but which didn't happen. So the reasons were very strange. I do not want to get into it, because the reality is that we have to apply a different set of accounting for lesser and lessee as per Ind AS 116, and therefore no point discussing why the mirror accounting has been stopped. But IASB, in the basis of conclusion, they have categorically mentioned what is the reason to stop using the mirror accounting for lesser and lessee. Barring a few exceptions, almost all the leases, whatever you may call it as finance lease or operating lease, as per the previous definition, all the leases will find place in the balance sheet to be recorded. There are a few exceptions which we will discuss in few slides later. So how my balance sheet and P&L would visually look like after the revised accounting position? So my balance sheet will have a right of use asset. What is the right of use asset? I'll just explain in few minutes. And a corresponding liability, just like a finance lease concept which we used to have. How my P&L will get impacted? In a very few circumstances where there are exemptions available, all lease expenses will not be there in the P&L, unlike the previous position. We will have depreciation and interest as front-loaded total expenditure. What do we mean by front-loaded? Though that means the sum total of these two expenses will be more in the beginning of the lease period, and as we go and deplete the liability going forward, or the depreciating that asset, the right of use asset, the depreciation and interest element both will slowly and gradually reduce. Therefore, The sum total of depreciation and interest will be higher in the initial years of lease and will go on reducing as we go along. How my balance sheet would look like? So finance lease in case of the previous standard, which was Ind AS 17, will continue to look like that. But whatever off balance sheet items were there, either as asset or liability in case of operating lease, will now be shifted to my balance sheet as asset or liability. Asset will be called as a right of use asset and liability will be lease liability for making the payment against those leases. How my P&L would get impacted, see and have a quick look to it. So if I talk about finance lease, we have revenue, we have operating cost, we have EBITDA, we have depreciation and amortization for the leased asset. If it is on finance lease for lessee, then we have finance cost as interest cost. In case of operating lease, what used to happen? We used to have revenue. Along with operating cost, we used to have single lease expenses. That single lease expenses will no more be there in Ind AS 16 financial statement, IFRS 16 or Ind AS 116 financial statement, as a result of which my EBITDA will go up. How? Because that line item as single lease expenses is no more there. This single lease expense, somehow, since we have the asset and the liability, because of the asset, the depreciation element will be there, and because of the liability, my interest element would be there. However, I would like to clear this concept here. The sum total of depreciation and interest will not equate to my previous single lease expense because, as I just mentioned, the sum total of depreciation and interest will be front loaded for the financial statements for a very simple reason. We have decreasing way or any other way of depreciating my asset, or for liability, obviously it will be a decreasing way because I will keep on adding the interest and keep on deducting my liability. Therefore, uh, every year correspondingly cannot be matched, but in the previous year there will be a substantial upside improvement or hike in EBITDA, and operating profit will also go up because the single lease expense will not be there and I will have depreciation instead and interest. So, as I initially said, barring a few exceptions, almost all the leases will find place in the balance sheet of lessee. I would like to remind here the lesser accounting remains unchanged. So, the same asset which is there in the books of accounts of the lessee as ROU asset may also be there in the books of the lessor as well, because they are still continuing the lessee lesser accounting as finance lease or operating lease. How one single asset may be there in the books of both? If, as per the lessee, if it is on finance lease, right? If it is if it is on operating lease, my apologies, if it is on operating lease for and from the perspective of lessor, then it will not de-recognize that asset and will remain in the books of the assets of the lessor. However, because of the revised definition of Ind AS 116, that particular asset, if it is not covered in the lease exemption, it will also be booked as ROU asset in the books of the lessee. So the dichotomy of this standard is that one single asset may find place in both the books of lessor and lessee post introduction of 116, but this is the fact, this is the factual position and we have to live with it. So there are two exemptions which are given as per the standard. One is if the lease is less than 12 months period. So we will not see the risk and reward or control model. If it is 12 months and less, the company can claim the exemption and may not follow 116 for operating lease cases. If the lease is less than a particular value which is called as low value, which is not defined in 116 though, then the items will not be accounted for as per Ind AS 116 for the lessee. So what are low value items? So there are some principles which are given, I'll just discuss. And the election of the low value will be made on lease by lease basis. So every single asset bought in a particular contract can qualify for getting and being called as low value, and hence the exemption can be claimed. An asset can be called as low value and should be called as low value only if the lessee can benefit from the use of that particular asset either at its own or together with other resources that are readily available. It should not happen that that particular asset which we are talking about or evaluating will be used with such a complicated other asset which is not readily available to lessee. The second condition is the underlying asset which we are evaluating is not highly dependent or highly interrelated with any other asset. So it should be capable of being used in isolation. That is the test. If that these two tests are met, that asset qualifies to be low value. But the catch here is, what is low value? Unlike IFRS 16, that value is not being defined. For IFRS 16, 5,000 USD has been defined as low value. But in India, initially, as I said, we were deliberating what could have been the possible low value. So few professionals were arguing 5,000 into the USD dollar, or 5,000 USD may be converted as it is in INR. So that means 5,000 INR, but those were speculations and didn't work that way. In India, practices have been developed based on the materiality of the organization, and every organization now has settled the low value for the purpose of Ind AS 116, which are largely not available openly in the financial statements, and it's been agreed internally as if for any other item the materiality has been decided. So why this change had happened? Quickly, I told initially that the ISB chairman had thought about the problem wherein the lessee kept on using it and fitting the use in the definition of in IS 17, and then continue to call it as operating lease and never booked it. So the change is brought to bring the the fair presentation of the items in the financial statement, so that the common methodology can be changed. Improved comparability, because most of the assets will be ROU in all the companies, irrespective of the industry or the sector they are dealing in. A lesser use of assumptions are there, that is being told by the regulator. Better decision making can be done, because now, as per them, I don't know, there are both the school of thoughts that we know that this is not the finance lease, still it is finding place, etc., etc. But this is from the angle of the standard makers. So as per them, the better decision making can be done, and transparency has been increased. So what is the scope of the standard? So as I initially mentioned, unless I know which aircraft or bus or transport I have to take, I will not be able to ride in the right vehicle. I will not be able to go to the right path. Therefore, as and when I think of applicability of any item, I have to be very, very sure whether this particular item falls within this standard or not. If I do not make that selection right in the beginning, anything else and everything else which is done afterwards is absolutely wrong. Therefore, scoping out and scoping in the beginning is a must. So largely and generally and mostly, whatever items are covered in other standards are generally scoped out from other standards. So that is the case, barring a few situations which we will discuss. So leases of all assets, including long-term leases of land, are covered here. However, following things are not covered. For example, minerals, oils, natural gases, and similar regenerative resources. Biological assets, which are within the scope of Ind AS 41. When we have service concessional agreement, there is an appendix to the standard 115, which deals with this type of arrangements for the infrastructure and other arrangements between government and non-government entities. Then we have licenses of intellectual property granted by lessor within the scope of Ind AS 115. So as you see, mostly those things are scoped out, which are covered somewhere else in other standard. Rights held by lessee under certain licensing agreement within the scope of Ind AS 38, I'm sorry, intangible assets, or for example, motion pictures, video recordings, etc., because these are covered in Ind AS 38. Therefore, these are scoped out from here. Lessee may, but is not required to apply this standard of leases of intangible assets other than those discussed above. So there may be other kind of intangible assets which may not have been covered here as scoping out. So lessee may, that means the lessee has a choice to apply this standard for those kind of intangible assets. Lease definition. This is the most critical part of the standard. So now we have boarded in the right plane, but there are different stops, right? If I do not tell the driver or the conductor the right place where I have to get dropped, I will not reach to the right destination. That's what I have to think of. So the lease definition is very, very important. The essential part was to identify whether I fall within this standard or not. If I have identified that correctly, if that definition of lease fits into my arrangement, my contract, if I am not sure about it, I will definitely make a mistake, because if it is not covered here, it will get covered in some other standard. We will understand one example as well. So identifying if it's a lease or not. If it's not a lease, it will not be accounted for as per 116. And unlike the previous standards like AS 19 or IAS 17, etc., the definition is quite tricky. It seems easy as a flowchart I've mentioned in my presentation, but it is difficult. In two of my clients, we actually struggled a lot. And just for the benefit of everybody here, I would like to tell you one thing. You would find basis of conclusions attached to each and every IFRS for a very simple reason. For drafting IFRSs, there is a due process which has been followed during the entire crafting of the standard, and therefore how and when and why the standard is designed in a particular way, the basis of conclusion covers everything. However, unlike IFRS, we really converge with IFRS with few exceptions, whom we call as carve in or carve out. Barring those few exceptions, there is no deliberation per se to craft that standard. Why and when, what is the definition of lease? That is directly coming all the way from IFRS. Therefore, the basis of conclusion will not be available for Ind AS while it is available for IFRS. So as and when why at times you're confused why this definition is so, why this concept is so, why this exception is like that, why it is not covered, why it is covered. While you're not getting answers to these queries, you go to basis of conclusion. Those are at times will give you an insight of those queries of why, when, what in a very beautiful manner, and you will be able to reach to the right conclusion. So I was just discussing something with one of our clients, and I think in Ind AS 115 we were not able to justify to our answer. We know that the standard says this, but it was looking slight weird why it should be like that. But correspondingly, in the basis of conclusion, we saw why that exception was there. They had very in a very lucid manner, or in a very beautiful manner, they had explained that this proposal was considered by the board and this was dropped because of this reason. So that gave us the answer and has the confidence to go with that solution. So in that alongside with the basis of conclusion, there are multiple examples which are given in the IFRSs also. And in couple of examples, if you see, they have made thin line differences, and hence they have changed the conclusion. So with a minor change in the fact, how my coverage gets changed is very beautifully covered and given in those examples. And hence it is imperative for us, along with reading the standard, we should read the basis of conclusions and those examples which are given along with the IFRSs. So that saved my life once when we were discussing, accounting for leases for one of our very big client in case of a solar panel, what they installed. And we could reach to the right conclusion because of, there were three similar example in the form of A, B, C with slight modification. So we could demonstrate that whatever we are thinking is right. Therefore, and that too, that was part of the lease definition only. So we were not talking about at an advanced stage. We were struck identifying whether it's a lease or not only. So lease definition. And for now, purani definition ekdam bhul jao. Let's read it afresh, because that will keep confusing you. So it is important to compare line by line, word by word definition when it's absolutely new standard, because आपकी memory भी पुरानी वाली रहती है. So now it's been a few years, so you can forget the previous definition, unlearn and learn new. So now just focus on the definition which is given, otherwise you'll get confused. So just read these highlighted words carefully. Contract, lease definition means contract or part of the contract that conveys the right to use the asset for a period of time in exchange for consideration. I said a purani definition bhul jaye, but I want to take you back to the previous definition for a while, for a very simple reason. जब हम lease की बात करते थे पहले, तो बहुत सारी चीजें, risk and reward, longer period of time, my remaining useful life, etc., etc. We used to talk about those, but आज की जो डेफिनेशन है दैट सेज, अगर आपको 12 महीने से ऊपर, 12 महीने में क्यों बोल रही हूँ, बिकॉज that 12 months exemption has been given in the scoping paragraph. So if any asset which is more than 12 months period gives you the right to use that asset for that period. So no matter you have the ownership, no matter you will be able to buy it, no matter you substantially use it for the useful life of the asset, etc., etc., what we ever seen and read, any contract or a part of a contract which conveys right to use that asset for a period of time, that particular period of time जिसमें आपको वो right of use asset मिला है, for or in place of consideration which is payable, that will give me the definition of a lease. Lease term is what? Non-cancellation period for which the lessee has right to use an asset together with both. So दो exceptions है यहाँ पे. So I do not want to read it verbatim. I'll try to explain it in my own words. So आपका अगर lease period initially 10 साल का है और आपके पास एक extension possibility available है for next 5 years, you will consider that extension possibility and call it as 15 years time if at the beginning of the inception you are sure that I will exercise that option. I know the perception might get changed, or decisions might get changed depending upon. So you have seen the COVID possibilities. Onerous contracts were identified in multiple organizations, even if that was not there initially. So barring a few exception, अगर आपके पास reasonable surety है in the beginning that the period will get extended, then you will consider that as a non-cancellable period. Similarly, on the contrary, if you have the initial period of 10 years, but you have a termination right, for example, after a period of 6 years, and it is sure that you will exercise that period, then you will reduce those 4 years and consider 6 years as non-cancellable period. Passing the test of lease. So far, if you were here and there and your energy was going down, please bring all your energies back, because this is very, very crucial and the heart of the standard. So I know everything else is also important. My hands are important, my head is important, but heart is most important. So these two slides are the heart of the standard. So passing the test of lease, first of all, we have to identify 3-4 layers. So this is quite complicated in this standard, but I have simplified it for you. So the idea of today's session is to give you the entire skeleton, to give you the flavor, what all things are there, so that once you step into the standard, you can read through the standard. So the conditions or the passing milestones which I'm showing you on the screen are in a very brief, but it has a lot many options are there. So please read through the standards alongside. Not now, later. So is there any identified asset? If yes, then you will remain in the standard. If no, if not, then you will be out of the standard for a very simple reason, because the contract will not contain a lease. So दो चीजें हैं, एक तो आपको स्टैंडर्ड में आप आते हो या नहीं आते हो, जो हमने स्कोपिंग स्टैंडर्ड में देखा था वो आपको देखना है. सेकंड, अगर वो लीज ही नहीं है तो वो तभी भी फिर स्टैंडर्ड से स्कोप आउट हो जाएगी. सो आइडेंटिफाइंग द or passing the test of lease is very essential. So if it's identified asset, it will remain in the standard. If it is not, then it will go out. What do you mean by identified asset? उसका एक टेस्ट है. आइडेंटिफाइंग एसेट कैन बी स्पेसिफाइड एक्सप्लिसिटली और इम्प्लिसिटली. मतलब आपको किसी स्टैंडर्ड में बोला है कि मुझे कार चाहिए, मुझे कार से ही अपने एम्प्लॉइज को ट्रैवल कराना है. सो ट्रक नहीं आएगा, बस नहीं आएगी. सो दैट्स अ स्पेसिफाइड एसेट. It may be explicitly written in the beginning of the contract, it may be somewhere else written in the entire contract implicitly. So we have to be very cautious while we read the standard. So no identified asset if supplier has a substantive right to substitute. मतलब अगर supplier के पास उस asset को चेंज करने का राइट है. फॉर एग्जाम्पल, अगर आपके एम्प्लॉइज को टू एंड फ्रो लाने के लिए एक कार आइडेंटिफाइड है, तो वही कार रोज आएगी. अगर सप्लायर भेजेगा तो एसयूवी ही, लेकिन कोई सी भी एसयूवी और कोई से भी नंबर की एसयूवी भेजेगा, तो वो आइडेंटिफाइड एसेट नहीं होगी. आइडेंटिफाइड एसेट हैज टू बी physically distinct and has to be specifically available for the contract. The next test is customer has, so अगर मेरा ये test pass हुआ, then I will see my next test, which is customer has right to substantially all the economic benefit. If it is the case, I will again remain in the standard. If it is not, I will go back and scope out from the standard. What do we mean by substantially all economic benefit? मतलब जितना भी उसका आउटपुट है या उसका बाय प्रोडक्ट है वो मेरे पास है, मेरे पास राइट टू डायरेक्ट है, और वो जो राइट है मेरे पास वो ओनरशिप की वजह से नहीं आया है, वो यूज की वजह से मेरे पास आया है. सो द एसेट शुड बी आइडेंटिफाइड एसेट. द कस्टमर शुड हैव द राइट ऑफ सब्सटेंशियली और द बेनिफिट. ऐसा नहीं कि 2 घंटे आपने वो गाड़ी किसी और को यूज करने के लिए दे दी. अगर वो आपके पास है 5 महीने के लिए, 6 महीने के लिए, वो आप ही के एम्प्लॉइज के लिए यूज होगी, किसी और के लिए यूज नहीं हो सकती. अगर आप अभी भी स्टैंडर्ड में बने हुए हैं, देन यू हैव टू सी हु हैज right to direct how and for what purpose. So these are two, this is a combination condition. So how and for what purpose. So there is a detailed guidance in the standard and the basis of conclusions and the examples given in IFRS. Please read through those if you're struggling. And institute also has an educational material, so please read through that as well. So if customer can direct how and for what purpose the asset can be used, the contract contains a lease. If these two rights remain with the supplier, then the contract does not contain a lease. What do you mean by how and for what purpose? That means the entire decision making कि कैसे यूज होगा और किस काम के लिए यूज होगा वो किसके पास है. एट टाइम्स क्या होता है कि कुछ प्रोटेक्टिव राइट्स होते हैं. सो फॉर एग्जाम्पल एक अभी हम नेक्स्ट स्लाइड पे एक एग्जाम्पल देखेंगे जहाँ पे लिखा है कि शिप का एक एग्जाम्पल है. सो अगर सप्लायर आपके ऊपर ये कंडीशन लगाता है कि आपको हर 1000 आवर पे ओवरहॉलिंग करानी है, आपको एनिमी कंट्री में शिप को लेके नहीं जाना है, सो वो प्रोटेक्टिव राइट्स हैं, वो रेस्ट्रिक्टिव राइट्स नहीं है. सो इन दैट केस हम ये नहीं बोलेंगे कि वो राइट अभी भी सप्लायर के पास है, इसलिए कस्टमर के पास वो राइट नहीं है और देयरफॉर द कॉन्ट्रैक्ट डज नॉट कंटेन अ लीज. दिस इज नॉट. सो दैट्स द रीजन दिस रेड लाइन सेज अगर प्रोटेक्टिव राइट कस्टमर के पास नहीं है, सप्लायर के पास है, तब भी बाकी राइट्स अगर कस्टमर के पास है और मेरी पुरानी 3 कंडीशंस पूरी होती हैं, तो दैट विल कंटेन अ लीज. इफ इट्स अ लीज, देन वी विल मूव फॉरवर्ड. So this is a simple example. I'll run through it separately, quickly, because I will not be able to meet my desired content then. इसमें क्या है कि एक customer has received a ship for 5 years time as per customer's direction, discretion it can be used. There are other than protective suppliers, right? कोई और right नहीं है. So this is a lease for 5 years. The customer will use it, book it as lease in the books of accounts as ROU, corresponding liability as lease liability. This is a contrary example where a customer enters into a contract with the airport operator to make use of any available space. Maybe वो space defined भी है, suppose 5,000 square feet उसको हमेशा मिलना ही है, लेकिन वो space defined नहीं है, कौन सा वाला bin, कौन सी वाली tray या कौन सा वाला area, कौन सी वाली floor. So in that particular case, this will not be a lease for a very simple reason. My first test of being identifying asset fails and it is not a lease. What is composite lease? कई बार आता है कि आपने लिफ्ट लीज पे ली, उसके साथ AMC आपकी composite आई. So उस केस में there is a rule that you have to bifurcate. One thing will go as lease, the other one will go in 115 as service element. So the standard gives you a liberty not to separate, but अगर आप उसे separate नहीं करेंगे तो आप उसे lease single content आप उसे मान सकते हैं, but वो 115 में नहीं जाएगा. So this option needs to be exercised for the entire class of asset. You cannot do cherry picking that for a particular class of asset. आपने कुछ assets को composite lease ले लिया, कुछ assets को आपने bifurcate कर लिया. If you choose to make it composite, you will do it for the entire class. Yes, composite lease के जो condition है वो ये exactly the similar condition है जो हमने low value को identify करने के लिए की थी, तो I'm not discussing that in detail. Now, what we have done so far, we understood the concept now that the lesser lessee concept is different. Lesser will continue to have finance lease and operating lease. Lessee will recognize as ROU, right of use asset, and the corresponding liability जैसे हम finance lease में करते हैं. मिरर अकाउंटिंग खत्म हो गई है. 2 एग्जाम्पशंस थी. 12 महीने से अगर आपकी कम लीज है तो आप उसको, आपके पास चॉइस है, आप उसे 116 में अकाउंट फॉर ना करें, उसको लीज 116 के हिसाब से ना करें. एंड दूसरा लो वैल्यू इंडियन स्टैंडर्ड में डिफाइंड नहीं है, IFRS में डिफाइंड है, दैट्स अ 5,000 USD. If your asset doesn't get exempted, then you have to account for as per 116. If it's a lessee, all the assets are to be booked as ROU asset with a corresponding liability. Then we understood the scoping, what all assets are covered in some other standard will not be covered here. Then we understood the concept of nothing. Then we are here, how to calculate. Yeah, we understood the concept, main heart of the standard. My apologies, was heart of the standard is whether the contract contains a lease. मतलब वो lease की definition भी fall करता है या नहीं, and that is the most important test whatsoever for the entire standard. Now अगर आपकी exemption नहीं है, आप standard में fall करते हो और वो contract lease भी बनता है, तब वो lease liability कैसे calculate करना है, ROU कैसे calculate करना है, initial measurement उसका कैसे करना है, subsequent measurement क्या करना है. I will take another 10 minutes to cover that up and then few questions. So initial measurement is quite easy. So present value of the lease payment जो भी आपने unpaid है as on date, then आपको उसमें जो fixed elements है, fixed payments है, that will be included, less any lease incentives receivable like free period or subsidized period etc. जो आपके lease incentives में आते हैं. अगर कोई purchase option है which is exercise price, but that should be reasonably certain. If that is being paid, that will be added to the lease liability. Residual value guarantee will be added. Termination option penalties, if these are there and these are sure to happen, then these will be added to the lease liability. Variable lease payments will only be considered if these are not based on turnover or usage etc. These are based on some index, some rate at the commencement, if it is agreed between lessor and lessee. these will form part of the lease liability. We'll do a quick example also and you'll be clear about it. Subsequent measure, as if we prepare the PV table, आपका initial liability होता है, उसमें आप interest add करते हो और उसमें से liability year on year आप reduce करते जाते हैं. इसीलिए I was saying that the expenses will be front loaded because beginning में आपका interest ज़्यादा होगा, depreciation ज़्यादा होगा, तो sum total of interest and depreciation ज़्यादा होगा. So year on year आपके sum total of depreciation and interest will keep on reducing. You will have to remeasure the liability in case if there is a change in the term or variable rate, etc. And corresponding adjustment will be done to right of use assets. How we will see. अगर हम राइट ऑफ यूज एसेट की बात करेंगे तो इसमें सबसे पहले आप लायबिलिटी कैलकुलेट करते हैं, जो हमने अभी फॉर्मूला देखा, एंड देन वी विल कैलकुलेट द राइट ऑफ यूज एसेट. Right of use asset will be calculated. We'll start with the base of lease liability, what we calculated, and then we'll make certain adjustment. What are these adjustment? अगर आपने कोई लीज पेमेंट बिफोर और एट द कमेंसमेंट दिया है, ये एग्जाम्पल से अभी क्लियर हो जाएगा. देन अगर आपने कोई इनडायरेक्ट कॉस्ट इनकर की है वो आपका आ जाएगा. And then restoration or dismantling cost, if there is a possibility and that's been agreed, that will also be added. And this will have a deduction for incentives what are received against the right of use assets, which we will see in the example. एक छोटा सा example अभी इसके बाद देखते हैं. Subsequent measurement क्या होगा कि एक बार आपने right of use asset बना लिया, ये calculate कर लिया, that will be considered as any other asset which can be either treated as Ind AS 116 or Ind AS 40. So मतलब एक बार आपका right of use asset बन गया, वो आपका normal asset की तरह treat होगा. So जो उसका depreciation हम calculate करते हैं, impairment testing करते हैं, वो सारी चीजें आप ROU asset पे apply करेंगे. एग्जाम्पल है, एक 10 साल की लीज है, उसमें लीज पेमेंट है 50,000 USD जो पर एनम पे होते हैं बिगनिंग ऑफ द ईयर पे. सो आपका जो पेमेंट बचेगा पे करने के लिए वो 9 इयर्स का बचेगा बिकॉज 50,000 USD आपने बिगनिंग में पे कर दिए. ऑब्टेन करने के लिए लीज के लिए यू हैड इनकर्ड डायरेक्ट कॉस्ट ऑफ 20,000 USD, आउट ऑफ विच 5,000 वर पेड टू द एजेंट, और लेसर ने एज एन इंसेंटिव उसको कॉम्पनसेट करने के लिए वो 5,000 रियम्बर्स करने की बात की. तो दैट बिकम्स माय लीज इंसेंटिव. इंटरेस्ट रेट इज 5% पर एनम. सो हम लाइबिलिटी इज वेरी सिंपल इन दिस केस. हाउ वी विल कैलकुलेट लाइबिलिटी फॉर 50,000 फॉर 9 years बिकॉज एक साल का आप बिगनिंग में दे चुके हैं, तो अनपेड आपका 9 साल का बचा. So you will calculate 50,000 USD discounted at 5% per annum, which will give you USD 355,391. Then right of use asset के लिए जैसे हमने बात की थी, we'll start with the lease liability and then we'll make the adjustment. जो हमने advance में payment किया था 50,000 पहला installment, we will add it back to it. Indirect cost जो हमने incur की थी 20,000, लेकिन 5,000 will be considered as my incentive which will be reduced. So this will give me the sum total for right of use assets. So these two will be my initial measurement and I will book these respectively on these cost. 355,391 will be my initial liability for lease. 420,391 will be my right of use asset which will be booked. अब आगे क्या होगा liability के लिए? In this 355,391 I will keep on adding interest. I will keep on deducting my installment. That will give me the PV table and I will keep booking interest and the closing liability. For right of use asset, it has become my normal asset. I will depreciate it either on SLM basis or any other representative basis. This amount will be subject to impairment also, derecognition also, जैसे कि हम बाकी assets के लिए करते हैं. So, जो मैंने आपको बोला ये सब स्लाइड पे है. So this is the present value table. Now we are largely done with the accounting, the revised accounting pattern for lessee. Let's have a quick look to the lesser accounting. As I've been saying that the lesser accounting remains unchanged. So how we do, initially हम लोग operating और financial lease में book करते हैं. अगर finance lease है, so what do? We derecognize the underlying asset and recognize a net investment in the lease. and any selling profit or loss is recognized. So it's not new, so I will not invest more time on this. So it's a normal finance lease accounting for lessor. We have been doing it. For operating lease हम क्या करते हैं कि जो भी हमारे expense होते हैं
Sarika ji, sorry to interrupt. Please be considerate as we have few questions from the audience and we have another speaker. So you will please accordingly manage the time of yours.
3 more minutes. So lessee accounting operating lease में जैसे हम करते थे वैसे करेंगे, and then we'll book the interest income and we'll follow the de-recognition criteria. Lesser accounting हमारी जो मैंने बात की थी कि indirectly क्यों change होगी, क्योंकि definition of the lease has changed and there are different guidances which we haven't discussed: sale and lease back guidance, sublease guidance, modification accounting, disclosure requirements, etc. And how lessee will behave based on the revised standard will also impact my lesser accounting. So if I compare with IFRS 16, three major things. IFRS allows me to use fair value for investment property. Ind AS does not allow it, therefore that option goes away. IFRS 16 says कि आप ROU को या तो separately भी book कर सकते हैं या रख सकते हैं, present कर सकते हैं, या बाकी assets के साथ भी आप present कर सकते हैं. वो option इंडिया में नहीं available है. IFRS ऑल्सो अलाउ करता है कि जो आप कैश पेमेंट करते हैं इंटरेस्ट पोर्शन के लिए लीज लायबिलिटी के, आप उसको या तो कैश फ्लो स्टेटमेंट में ऑपरेटिंग एक्टिविटी की तरह दिखा सकते हैं या फाइनेंसिंग एक्टिविटी की तरह. Ind AS 7, sorry, this is Ind AS 116, sorry, requires to show you this as financing activity only. So that's it from my side. I'm open for questions now. So as I would like to give a caveat again, whatever is my capability, I'll try to address. If something remains unaddressed because of the paucity of the time or my inability, I will get back to you post my research. Yes, Santosh.
Thank you, Sarika ji, for wonderfully covering all across this 116. And I don't think that there is need for me to further explain what wonderfully you have covered right from previous and revision positioning to the closer in terms of the lessee and the lessor's statements positioning. Now we have one audience, Mr. Nikun Shah. I requested you to please write your question in the chat box if it is possible, so that can we spoken here and then audience can get to know about your question and she can answer. Or you are given right to speak, Mr. Nikun Shah, if you can speak and raise your question.
Hi. Actually, my question was that currently, if we are providing cab service or car service to any key managerial personnel, and if 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 the if we have option to change the car, so would it be cover or would not be cover in the
See,
lease?
yes, I would address this query. So as I mentioned that, the lease test which I discussed, it has to be a specific asset. If the supplier has the right to change the asset, it is not the identified asset. Therefore, it will be scoped out from the definition and hence will not be covered under 116.
Is there anyone
Okay, thank you.
else to raise any question pertaining to this India's 116, which Sarika ji?
Okay, thank you so much, everybody, for patient listening. Hope I could do justice to the time given to me.
Is there anyone else who can raise the question on 116, India's 116? Anyone wants to raise the question? Okay, Sarika ji, I think there could be possibly more questions the people may write, and I may pass on to you the question, maybe in written mail. We can then respond to the audience.
Sure. Okay, thanks.
We have a problem. Yes. Sarikaji, please.
Your voice is quite breaking, Santoshji. Am I audible?
Sarika ma'am, can you hear me?
Hello.
Sarika ma'am, can you hear me, ma'am?
Jatin,
Sarika ma'am.
maybe some network issue at my end. I'll try to reconnect this.
Okay. Okay, ma'am.
I think if you can hear me, we can continue with the next
Can you hear
session.
my voice?
Because Samir is waiting. So
Your voice is breaking, ma'am.
please continue with the next
Your-
session. Jatinji, you can give me the questions and I'll respond back.
Okay, okay, ma'am.
Am I audible? May I have another question from the audience? There was disruption of the internet connectivity in between. Okay, so I may request audience to please write your question in the chat box and I will take it up to Sarika ji. And after the session, another session we have. So let me take the opportunity of introducing, inviting our next speaker. We have another session on Indian Accounting Standard, Ind AS 115, that's revenue from contract with customers. Friends, as we know, the objective of Ind AS 115 is to establish the principles that an entity shall apply to report useful information to users of financial statements about the nature, amount, timings, and uncertainty of revenue and cash flow arising from a contract with a customer. So to cover on this particular topic of Ind AS 115, we have Mr. Samir Malik, partner with Grant Thornton Bharat LLP. Mr. Samir is a partner there and has over 17 years of experience in working with clients across sectors. During his career, he has led multiple IFRS and US GAAP advisory engagements, including GAAP conversions. He has also extensive training experience for delivering sessions on Ind AS and international GAPs. May I request and invite Mr. Samir Malik, please turn your cam on and take over the session.
Thank you, Santoshji. I hope you can hear me.
Yes, I can hear your voice, sir. Please, thank you.
Great.
Over to you, sir.
So should I start or should we wait? Are we waiting?
Yeah, you may please start. You may please start.
So I basically see at least 4 people have raised their hands up. I guess from the last session, they can just send their questions to Santoshji and I think Santoshji will take up.
So I am requesting back to them again to please write their respective questions and I will take back the questions with the Sarika ji after your session.
Right. So yeah, so of course, good evening everybody, and it's a chilly, Delhi evening or afternoon, as you would say, and great to see Sarika ji after so long. We've worked together in past, so it's been a while, and great to see her here. I'll cover this session. I will share my screen and run this and those of you who know Ind AS 115 would know that this standard can be talked about for the entire day and you would still not be done. And for that, I am to blame. Santoshji and Jatinji gave me an option of choosing the standard, so I chose 115. And in 40 minutes, 115 is going to be one super crash course. But I think what I try and do is cover an overview of the standard, talk about.
Samir ji, sorry to interrupt. Can you take your mic closer so that the voice is audible because we are unable to take it a bit low. Actually, it is.
That should
If you
not
can
happen
take your
because
mic closer.
my mic
Yeah.
is here, so it can't be any closer. And I do the unless there's a
Okay.
problem with this software, it shouldn't happen because I end up wait. Okay, wait, let me just choose the maybe the mic is maybe the software has selected the wrong mic. Let me just check. Yeah, wrong mic.
Yeah, is it better now?
Yeah. Perfectly
Yeah.
fine now.
Yeah. So I have all of us work from home, so we have too much hardware around. Three mics, the wrong one put here. Uh, okay. So I'll try and cover. I'll try and cover the standard overview and possibly make it easier to understand. I'll take something from the last session that Sarika ji had covered, that uh, a lot of reading and a lot of application has to be done by people themselves. When you have a real life situation, you will have to go back and read and see where does that situation fall into the standards guidance. What we are here to do is to enable you to understand the structure of the standard and where to look for what and what does the standard convey overall, right? So that's the objective of this session. I would start with this. I often take interviews and talk to people around 115, and I normally end up asking people what has changed. What has changed between the AS9, the Ind AS 18, now Ind AS 115. What has changed? Everybody can say the first line, which is now there's a 5-step model. But what does that 5-step model do? And does it change anything for the accounting on the books or not, is the real question. And I think that's what I'm trying to answer here. And the first thing we should all understand is the standard, actually the objective of the standard is to align a lot of guidance. There was Ind AS 11 for real estate, there was Ind AS 18 for others, there was guidance on advertisement, there were guidance on barter, there were multiple things, multiple different guidance floating around in different places. One. Second, this Ind AS 115 is basically something that came from IFRS 15, right? And IFRS 15 and ASC 606. ASC is basically accounting standard codification, which US uses. ASC 606 are joint projects. So US and ISB, basically FASB and ISB did a joint development of the standard, and they came up with a aligned basis of recognition of revenue. Now, in that alignment, the objective wasn't to change anything, drastically. The objective was to align and make a principle that can be applied. And because of that principle, of course, some things changed. And we'll talk about those, what changed. But some things changed. But the objective of the standard, unlike Ind AS 116, where the objective was to considerably, change the lease accounting, here the objective wasn't to change. The objective was to give principles for alignment. Okay. Next, I will share my screen, and then we can quickly rush through this standard. Do I have the right to share, because the share button seems to be not working?
Yeah, you are given the rights, please.
Okay. Okay. Do you see the screen?
Yes, we can. We can see the screen.
Okay. All right. Okay. So while you can see my screen, this is the first slide that Mohan talked about. Revenue from contract with customer, basically the standard is structured in 5 steps. And the 5 steps start with identifying the contract, identifying the performance obligations, determine the transaction price, allocate the transaction price, and then identify the timing of recognition. Most interesting part, of course, is the timing of recognition, which is the 5th step. But we'll talk about the first 4 also. And let's start with the first one. And the first one is often looked at as a very big item, but I would normally think that it's not. It's merely a step, and contract just means the rights and obligations of 2 parties can be established. And why is that required? Is because if the contract generates an asset or a liability, for example, somebody has paid advance under a contract, and you are obligated to provide services, you need to know whether it's a contract for revenue, or if somebody has paid advance, are you obligated to pay back that money? So is it like a loan, or is it like an advance for which you have to give services or supply goods? So that is why identifying whether there's a contract or not is important, because the accounting for a loan versus accounting for an advance given for services or goods is very different. So hence that identification of a contract, when do you start taking things into the revenue standard, is important. Having said that, of course, most of us have read the Contract Act, and even in India, oral contracts are enforceable. While most cases we will not see in commercial transactions oral contracts, but contract just means promises can be established, promises can be identified. One party pays the money, other party gives goods in return. The timing could be different. One party pays money in advance, or one party gets a credit of 60 days to pay the money after the goods are supplied. So there could be different terms of the contract. So whether it results into an advance, whether it results into a debtor, whether it results into accrued revenue, for example, the billing is supposed to be delayed 1 month after the product is delivered and accepted by the customer. So different obligations could arise from a contract. So hence the contract is necessary. But often in for example, retail, where you go to a mall and you buy something from the shop floor, the shop owner doesn't need to identify the contract. It's an instant contract. You pick up stuff, you give it to billing, they ask you for money, you pay the money. So you don't go through the 5-step model to identify whether there was a contract or not. Does the contract need to be written? The invoice itself is a contract in that case, right? And a very short period of time. So that's pretty much the relevance of identifying a contract. What is important though is in commercial transactions that we see often, there are multiple contracts entered. I picked up one thing from the previous session on solar panels. Now, if you worked in that industry or are aware, solar panels are often delivered and then installed. So often, due to tax considerations, etc., there are separate contracts for delivering solar panels and installing solar panels. Whether you would consider those 2 contracts between 2 same parties entered at the same time as a single contract or a separate contract, so that you can apply these 5 steps to a single contract or 2 separate contracts. So then the timing and everything is looked at separately. Or if it's a single contract, then everything is looked at together. So that is where this flowchart comes in, and this is part of the standard. The concept is part of the standard. It says whether the contracts were negotiated as a package in a single commercial objective. Was the objective of commercially negotiating the contracts together? Yes, it's a single contract. Does the consideration in one contract depend on the price or performance of the other contract? If yes, again, it's a single contract. Are contracts for a single performance obligation? That means that if the 2 things that are being given in separate contracts are actually so related to each other that they have no relevance without each other, then they become a single performance obligation. Performance obligation means the person who's selling goods or services, what is his obligation in the contract? And hence, if it's a single performance obligation, then also it becomes a single contract, even if you legally have two separate documents, two separate transaction prices, two separate terms, but it will become a single contract. And of course, if all the three are no, then it becomes separate contracts only. I will talk about a performance obligation concept and what is distinct and what is not. But this is the concept of a single performance obligation and a single contract. This is where we normally call it combining contracts. So that's what the slide says on top. Okay. Yeah, so of course the parties have to be same and the contracts have to be entered almost at the same time, because if you're saying that you have entered a contract with two different parties, then it does not make any sense combining two separate parties' contracts. Same with if a contract is entered 1 year before the other contract, then it's actually no obligation. You can pretty much say all these are separate, and you will get the answer to these questions also as no. Now, I think the second step, that was contract. Second step is identifying performance obligations. That just means what do you have to do, and why is that required? Is because unless you identify what you have to do, you will never know when do you have to recognize revenue, because you can recognize revenue only when you have identified what you have to do and when you have done what you had to do. So that's identifying performance obligations. There is a, performance obligation goes by the word promise. What is your promise to the buyer? Buyer of services, buyer of goods, buyer of real estate, whatever, the buyer of, whatever whoever is your customer, what is your promise to him? That is performance obligation. Now, whether the performance obligation is a single performance obligation or multiple performance obligations, or are they so interrelated that they can't be separated, while they may look separate but they can't be separated, is what you need to see. There are two conditions or two stage evaluation for a performance obligation to say whether it should be clubbed with other performance obligations in the contract or should be kept separate. The first condition is an overarching condition to say, can the customer benefit from the first promise, or the promise that we are evaluating, on its own, right? On its own, or with readily available resources from the market, right? So let's take a very, very, very simple example. If you sell a car and fuel together, is it one thing that you are selling, or you are selling two separate things? Well, fuel is available in the market almost everywhere, right? So car and fuel can be separated. Even if you were to sell car separately, car will have a value. You can get fuel from the market and use the car. So it's not that the car doesn't have a value. But if you are a specialty lift or an elevator provider, and that elevator can only be installed by you because it's so specialized that can be only in industrial elevator can only be installed by that company which is made or manufactured that elevator. In that case, the customer has no value of the elevator alone unless he gets it installed. So that's where how do you distinguish between whether there is a difference between how the performance obligations hold value for the customer, right? And how a performance obligation can only be valuable if you combine multiple other promises along with it. Solar panel is a interesting example where you can argue both sides. You could say that the solar panels have to be installed to be useful. But then the other argument is that, can somebody else install it? Are there other installers available in the market? You would probably get the answer as yes, there are other people who can install it as well. So even if you buy a panel, along with installation services, the panel itself could be a standalone performance obligation, right? So coming to the second stage of distinct. Now, within the context of this contract, can the performance obligations be identified separately? And are they so interrelated that they can't be separated, right? So if you see how, of course, it's a very judgmental dialogue whether they can be identified separately from the promises in the contract. But if you see the three conditions on the bottom of the page, you could see that is there a significant integration required? Is there significant customization required? Are these two highly dependent or interrelated? Like both the performance obligations are interrelated on each other so that it doesn't have a standalone. In that case, you will get an answer of combining these performance obligations. An example of this could be when you sell a software to somebody and that software has to be customized to be usable. It has no use unless it's customized to what the customer has asked for, and nobody else can customize it, right? So in context of the contract, it is not distinct because significant integration is required, or you could say a significant customization or modification is required before that first performance obligation is usable, and hence your customization service will be a second performance obligation that has to be combined. So that is where it talks about combining performance obligations and right. Okay, so that's performance obligations, an important step. Determining the transaction price. So transaction price is very straightforward in most contracts because here we are talking about determining the total transaction price. What is a transaction? Transaction is the contract. And when you have identified the contract, the entire consideration in the contract is the transaction price. Whether you say I am selling solar panels in a 500 rupee contract, you are selling solar panels for 495 and 5 rupees of installation, or whether you say you are selling solar panels for 250 and 250 for installation, is at this stage irrelevant. What you're trying to identify is what is the consideration. 500 is what the customer has to pay you in cash. That is the total transaction price. So that is what it's talking about. There are three things to see, or four things to see in a transaction price. Time value of money. That means if the customer is selling, or if the customer is giving you money only later, beyond 1 year away, then there is a time value loss that you have because there's a implicit interest in money, right? So that should be discounted while calculating the transaction price. If there is consideration payable to customer, for example, you asked, you are a supplier of, say, TVs or phones, and you say that, and you sell your products to a distributor or a showroom, and you tell the showroom that if you put my product in front of the showroom, I will pay you, I will pay you 500 rupees per day. Now, all you have done is you've sold your product to him and just asked him to put that product itself in front. So that is a consideration that you have paid to the customer. He has not sold you any service. That's not a service to put your product on the front. So in that case, it's basically anything that you pay back, whether you call it a cashback or a discount or a something like a slotting fees. The example I took is called slotting fees, where you slot the product in a certain place. All of that is consideration payable to customer and hence not not forming part of the transaction price. That means you will subtract it from the transaction price, whatever you are paying back. Variable consideration, again, that means that if the consideration is variable based on performance, this happens often when you are a construction contractor and the customer tells you that, if you construct and complete the construction in 1 month, I will pay you X. If you complete the construction in 2 months, I will pay you X minus 1. If you complete in 3 months, X minus 2. So it's not a penalty, but it's a variable consideration to incentivize you to do it earlier. So that's variable. Other type of variable could be where you have a volume based discount. That means if you say, if you buy 500 products from me during the year, I will give you a 10% discount. But if you buy 400, I will give you 7% discount. If you buy 300, I will give you 5% discount. Now at the beginning of the year, you will not give him any discount because he's not even bought 300. But you know that this customer will buy at the end of the year 500. So you know the 10% discount on the entire thing you have to give him eventually. Because the contract or the promise was entered at the beginning of the year, you have to estimate, and that is variable where variable consideration plays a role. Estimate the transaction price. Again, non-cash consideration is where the customer pays you by giving you something in return, which is not the same product. And if it is not, then that is added to the transaction price. So you give somebody a phone and he returns to you, say, the old phone, and he just pays you net amount. That doesn't mean that the value of the new phone or the revenue will be net. The revenue will be the cash received plus the non-cash consideration, which is the old phone. So that is how this will be looked at. Okay, that's transaction price. We've talked about significant financing component. If it is less than 1 year, that means the credit terms are less than 1 year, you ignore it. But if it's more than 1 year, you have to take it. You have to discount your revenue and take the transaction price as the discounted value. And then, of course, include interest income as your revenue. Now comes slightly more interesting part is allocate the transaction price to performance obligations. That just means that all the performance obligations that you identified and the combined transaction price that you identified in step 3, how do you allocate that combined transaction price to different performance obligations? And how you do that is based on multiple ways and the standard, and I'll talk about those on the next slide. But even if none of us would have read the standard, anybody can guess that the way to allocate anything should be a consistent way, right? So if I was to sell 3 things, which is for example, a car manufacturer sells a car and he sells 3 free services along with it. Now they are free services, but the value of the transaction is the car's price. That is what the customer has paid, but there are 3 services, and 3 free services are distinct because they are not. Car can be used without the free services. The free services are also distinct because they can be provided to other cars. So basically, they are technically distinct performance obligation of the manufacturer. How do you allocate the transaction price? The allocation should be based on the standalone transaction price, standalone selling prices, right? And standalone selling price of a car, you can see if you can calculate a standalone selling price of a car and standalone selling price of a service, and then allocate the value between the two. Or you could say cost plus. What is the car's cost plus profit? What is the service cost plus profit? And then allocate the transaction price between the two. So multiple ways, but the standard talks about these 3 approaches. Of course, if standalone selling price is available, nothing like it. But if not, then use estimated market assessment. That means adjusted market assessment. That means estimate what the customer will pay, consider competitors' pricing, and this requires judgment. But you can estimate what the customer will pay for each performance obligation, and then you divide the total transaction price in proportion of the individual performance obligations. So for example, if the transaction price was 100 and the standalone values that you get for 2 items is 90 and 20, so 110. So you will split 100 between the proportion of 90 is to 20. So you will get an answer which will possibly be something like 87 and 13, something like that, right? Expected cost plus margin approach, where you forecast what is the cost of each item, include a margin on each item. So going back to the car plus service example, the margin in service could be 30%. The margin in car could be 20%. So you take the cost of car, add a margin of 20%, take the cost of service, add a margin of 30%, and then say these are my standard selling prices. Use that proportion to allocate the total transaction price. Residual just means that if you have obligations identified and you know the standalone selling price of one of the obligations, then you can use that standalone selling price and recognize the residual as revenue of the remaining performance obligations. So that is only usable in limited circumstances. You can see the standard for those limited circumstances, but it's normally when the standalone selling price is actually available for a service. That means even in case of a car, if the standalone selling price is available for a free service, then you can use that and record the rest of the revenue for the car. One thing I would like to mention here is clearly that even if the contract mentions separate prices for different items in the contract, it does not matter. The standard requires us to look at allocating this total transaction price in the contract to performance obligations again. Even if you have to use the same amounts that are written in the contract, you will have to make a documentation that the contract prices are actually standalone selling prices, and we have just put those there in the contract, and they are not just values. And why is this very prevalent? The different values in the contract than the revenue? Because for tax purposes, for other regulatory purposes, often, or for even for just upfronting, some companies would want to recognize more revenue upfront, and hence would price the first product, the delivery, at higher than the service, so that they get more revenue upfront, so or more cash upfront. So the pricing in the contract could be different from the fair pricing. So that is why the pricing in the contract is ignored, and this is considered as the method of allocation. Now we come to the more interesting part. Okay. How much time do we have? Can you just let me know? I'll cover in as much detail, and then I'll leave 5 minutes for questions then.
You have enough time, Samirji. Please carry on.
Okay. All right. Okay. So the step 5, which at least is my favorite, and the fact that I've seen, everything else that we have covered so far are just logical ways of doing what we were already doing earlier in the previous standard also. They are now very logical. They are very structured now, identifying performance obligations, allocating transaction prices. But a lot of companies which had good financial reporting frameworks were already doing that. Now comes the change. What has changed? Because of aligning of models of different types of companies, service companies, supply companies, real estate companies, every travel companies, every type of company is now covered in the same definition. It just says that there are 2 ways to recognize revenue, 2 patterns. One, over the period of time, and second, at a point of time. That means if you're doing something which can be recognized as revenue over the period, we are not talking about what pattern over the period, we are just saying over the period. That means you can start recognizing revenue as you are working. And the second being, you can recognize revenue only when you've completed your work. That is point in time, right? So you could call it a completed contract method versus POCM in erstwhile language. But unlike earlier, or unlike Indian GAAP, there's no option. You have to do an evaluation to identify which of these methods will apply to your contract. Before we get there, one thing I would like to cover on this slide is control, the concept of control. The definition earlier of revenue, or the point of recognition of revenue, was always always referred to as the transfer of risk and reward, and often it was left to our imagination that, okay, risk has transferred, but reward is when you get entitled for money, or is it something else? And so there was different interpretations of what risk and reward stand for. Even today, risk and reward is part of the definition of control. It's not that risk and reward is gone and control is completely different, but control just gives you a better handle of, what is the point of transfer of a good or service, right? So if you see on the bottom where it says definition of control, it's actually saying that the control is defined as the ability to direct the use and obtain substantially all remaining benefits from the asset, right? So it's not focusing on risk as much. Risk obviously comes along with the benefits, but what has come in the definition is the fact that you can direct the use. That means you can choose what to do with the product or service, or have you already consumed it. So that is control. Controls means that you can choose. Somebody has dispatched goods. Can the customer choose what to do immediately after dispatch? Or the customer will only be able to choose when the goods reach him. So it could be a difference between what is the time of recognition of revenue, right? I'll move to the next slide. This concept will be clearer when we talk about point in time concept. But, or maybe we can talk about that first. This is the point in time concept. It says the entity has a present right to payment of the asset. That is, a point in time concept. The customer has a legal title to the asset. The entity has transferred physical possession. These are all indicators now, right? The customer has significant risk and rewards of ownership of the asset. The customer has accepted the asset. If these indicators are strong enough and are met, and these are indicators, again, you could basically say one of them is met, or two of them are met, or five of them are met, but at the same time it is a matter, for example, has the customer accepted the contract? Now when you accepted the good, when you buy something very standard, a branded product or a branded good, do you have to accept it? Because there's nothing to not accept, right? It's just standard. But when you buy something very customized for you, it could be a simple example, could be a tailor, and a more complex example could be when railway buys railway tracks or railway bogies. They do an inspection to understand whether it is made for as per their specifications or not, and each product is checked. So acceptance is relevant where acceptance has weightage in that contract, right? Not in a contract where acceptance is normally deemed. You can still not accept it. There could be a problem with the product, but it's not considered a material thing. It's not a significant part of the contract, acceptance. Software contracts, for that matter, software contracts have a significant acceptance often. If you would have, some of you work in software industry would know things like UAT, user acceptance testing. So some of those acceptance testings are very relevant to recognition of revenue for the supplier, so that is where acceptance comes in. But other than that, these are indicators of transfer of control. So that is, if these indicators indicate that the control has transferred, you recognize revenue at that point. Otherwise, you don't. Risk and reward, I would still wait and rate it as one of the more significant things, because at least historically we have related to this more and thought about this more. But physical possession, right to payment, legal title give you additional things to look at. Right. So I'll come back to now, once we have a fair idea of what control is. I'll come back to, does the customer control the asset as it is created? Now this flowchart here is the determination of which method of revenue recognition you use. Do you do point in time? Do you do over the period? as far as a service is concerned, the first step, does the customer control the asset as it is created or enhanced? In a service, there is no asset created, right? It's, if you are a housekeeping service for that matter, there's no asset created. So no. But if you were to take an example of a company building a bridge on the highway, now, even if it is half built, that is an asset. And even if it is an asset, it's on land which belongs to the government or public. That means the customer, which is the government, effectively controls the asset as it is being built or created or enhanced, because it is on their premises, on their land. So that's a simplest and the easiest example to say whether the customer controls that asset as it's being built. Does the customer receive and consume benefits as the entity performs? This example is perfect for a service. If yes, then control is transferred over a period of time. Housekeeping service, cleaning service. As days pass, you recognize revenue for each day, right? So that is over the period of time, because as you're providing services, the customer is consuming. The interesting example I would like to call out here is, logistics. Now a truck is moving, you gave a package to a truck and said, deliver it to Ahmedabad from Delhi. Now the truck is halfway through. Have you got the services already? Your objective was to get it in Ahmedabad. Halfway through to Udaipur is not what you want, right? So do you want that? Do you think that customer should the supplier should recognize revenue for the half work done or not? The answer, according to this definition, is that the truck has moved, and whatever happens, this service from Delhi to halfway, which is say Udaipur, you will not need to reperform, because the goods have moved already that much. So if that reperformance is not required, that means the service in theory has been performed partially and the benefits of the service have been consumed by the customer. Hence, 50% of the revenue for that journey can be recognized. And that is very tricky in this industry, because then you're talking about 50% of air revenue, 50% of logistic revenue, 50% of ship revenue. Well, ships still take a lot of time, but assume the amount of flights which are in air in the middle of the night on 31st of March. So year end, partial revenue can be recognized by airlines because they have done partial travel, even if the flight doesn't reach where it's intended to reach, but the revenue can be recognized. So that's a theoretical assessment whether the benefits are going. The next one, so if yes to first one, goes to control over a period of time, yes to the second one, control over the period of time. Third one is more interesting and very, very typical. Does the asset, let's say there's an asset being created in this. Now asset is inventory. For example, you're making something and you're making a crankshaft for a car. Does the asset have an alternate use for the entity? Can the entity sell that asset to somebody else because it's a standard asset? Now Samsung is today making mobile phones. It's in their factory right now. They are creating an asset. I have, for example, placed an order, but it's still being manufactured or it's still in transit somewhere. But does the entity have an alternate use for that asset? If yes, then the control is transferred at a point in time. That means the good doesn't belong to the customer yet, because the customer is not the one who's specifically the owner of the good or specifically designed that good. But let's take an example of a real estate apartment, very, very common in India. We all book apartments, and real estate, we know, building is being constructed. The builder is asking payments based on payment plans, the construction linked plans, etc. And there is an asset. Now, the land obviously belongs to the builder. The asset, so far as not transferred to us, legally belongs to the builder. We have a agreement to buy. That is the contract that we talked in step 1. Does the asset have an alternate use to the entity? You could say no, because builder cannot sell it to somebody else. You have booked a flat which has got a specific number, let's say 1024. You can't sell that 1024 number flat to somebody else. So it does not have an alternate use because it's booked by a specific person. But does the entity, which is the builder, have a right, enforceable right, to receive payment for the work done till date? Right? That means that you are, as a customer, you're not just paying advance, but you are paying or legally bound to pay for that flat and cannot cancel it because it's being made for you. But if you can cancel it, that means the dealer says, I have completed, let's say, the brick work, and please pay me, X amount, 50% of the payment. And you say, okay, no, I don't want to pay, cancel my booking. If that is the state, then it is not transferred over the period of time, and it will go back into point in time. That means the product is such, and you don't have a real, the builder doesn't have a right to force payment. He can apply late if the party doesn't cancel. He can, he can't take the party to court and say that he has to pay because he's obligated to pay. That's not possible. What you can do is cancel the booking at best. So if you don't have an enforceable right to payment, that means the revenue can be recognized only when the construction is completed and the apartment is handed over. Right? The conditions that we talked about here, legal title transfer, possession, risk and reward of ownership, all that transfers to the customer only then. So this is one big change that happened in 115 for real estate industry, who were earlier, based on a guidance note, doing over a period of time POCM method. But because of India's 115, most of them, and of course RERA along with it, which allowed the customers to cancel the booking and get refund apart from a penalty payment, it actually ended up being at a point in time. So that is what happened here. Of course, if you have a right to receive payment, control is transferred over the period of time. You buying a customized building, customized hotel, customized for yourself, the contract is bound to give the supplier or builder a right to receive payment for the work done till date. And this is what happens in customized machineries. When you make windmills for somebody, when you make turbines for a specific plant, they are made specifically, an asset is created, it has no alternate use. But if the contract was to be cancelled or abruptly something was to go wrong, the work done till date is payable by the customer. So that is where control is transferred over a period of time in specialized constructions. So that's the biggest concept of this standard. I will not take too much time. I will talk about customer acceptance. We have talked about already. There are some specific topics. I'm not going to cover many, just one today. And that one topic is because revenue is in a lot of discussion in news as well, for certain companies. But we should always look at something called principal versus agent considerations. That means that when you are reselling somebody's goods or providing services, by taking services, would you say that it is your revenue, or would you say that you are only a commission agent? Right? So even if you're receiving payment on behalf of somebody, for example, insurance broker receives payment, gives you insurance policies, but transfers that payment to the insurance company. His obligation is only to earn provide insurance company and not responsible for giving insurance benefits. He doesn't, when there's a claim, he doesn't pay for it. It is the insurance company that pays for it. Similarly, real estate agent for that matter, he may collect all payment on behalf of the developer from you, but he is not the primary obliger, he is not the principal, so he is an agent in the transaction. His revenue will always be net of what he collected minus what he paid or passed on to the actual primary obligor, which is the builder. So considerations for principal agent are extremely important. This standard defines them in 3 steps or 3 things. Primarily responsible. Who is primarily responsible for the service or the promise? Who has the inventory risk? Inventory risk means, let's say, if you were not able to sell a product, the inventory will be lying unsold, and somebody will be incurring that loss or the risk of inventory being unsold. That's inventory risk. Inventory risk is not a literal thing to use for inventory. It can also be talked about, let's say, for trucks or freight, right? Where a freight company has a lot of trucks parked in their garage, and if they don't receive any bookings for transport, the truck is effectively eating into the depreciation for the trucks is their inventory risk. So inventory risk just means the cost of not providing services if you don't get orders. So that's the risk of incurring cost. The third one is if the entity has a discretion in establishing prices. So if you can decide how will you price it, that means you can decide how your commission is also. So that means that the inventory risk, the price risk or the price can be determined by the person who is then a principal. So these are the indicators for principal agent, but very judgmental. These are indicators only. The other way to, one more thing I would like to say is, the other way to look at these is, do you receive or do you obtain control of a good or service from another supplier and then after that you transfer, or do you never receive the control? If you never receive the control of good or service, then you are an agent. If you receive the control of good or service, then you could be the principal. That's the shorter way to put it. I think that's all I would like to cover here today in this very, very quick and short session. There is a lot of reference material available on India's 116. It is, as you see on the screen. I'll talk about the more, as you say, exotic ones. The basis of conclusions in IFRS and ISB, you can actually download this from ICI website also. ICI calls it, India's support material, and you can download that from ICI website. It has a lot of discussion, and that very relevant discussion gives you an understanding of the standard. As Sarika ji was saying in the previous session, the fact that IFRS talks about $5,000 as the low value asset for India's 116, that's written in the basis of conclusion for IFRS. It's not part of the standard there as well. It's in the basis of conclusion. So basis of conclusion is a very relevant topic. It just talks about when the standard setters were setting the standard, what were they discussing and why did they write up a specific paragraph. So that is there. Internationally available ASC 606 and IFRS 16 guides, you can use them almost as is because these standards are almost similar to India's 606 and IFRS 15 it should be. And TRG issues are FASB, which is the US accounting body, set up a transition resource group for ASC 606, which is revenue. And they they discussed a lot of practical issues that happened. So if you search TRG issues online, you will get a lot of issues already discussed and concluded there with good basis of why. So that is a good read. And of course, the ICI disclosure checklist is a good thing to follow because India's 115 has a lot of disclosures to cover. So that's all I had for this session. I don't think we have more time to cover more concepts, but that's something that I wanted to talk about. Thank you.
Thank you very much for your enlightening session on India's 115, Samirji. And we have a question for you from Mr. Ankit Agarwal. He writes, how is revenue recognized in cases where customer has the right to return the goods over a period of time?
Okay. Yeah, that's a good question, and I would have wanted to cover it specifically, but I'll still tell you. The right of return of revenue or right of return of goods and services is normally considered a implicit right in anything that you do. And let's say you buy goods from a mall, lifestyle or somebody, and they give you a 30-day free of no questions asked return policy. Do you recognize revenue then? Does lifestyle rather recognize revenue then, or does it wait for the goods to come back? No, you can recognize revenue immediately. The right of return is considered a provision. That means you reduce and make a provision for returns based on expected returns, based on past patterns. But right of return doesn't mean the control has not transferred. So the control has transferred to the customer. He can give it back to you. That's a separate thing. So in context of what we discussed today, the point where the control transfer to the customer and his choice to give it back to you or not is past. So you can recognize revenue immediately when the goods are handed over to the customer, but you have to create a provision for that to come back.
May I request any other participant who has any question pertaining to this Ind AS 115? If there is any more question, or if not right now, then you may like to write in the chat box. We will try to get your answer from Mr. Samir and will pass on to you. In the meantime, I think the couple of questions were raised on Ind AS 115, and Ms. Sarika had to leave for another meeting. But however, we have got the answers of all such questions. So we are replying one by one over here. We will also write these questions in the email to all those who have respectively sent the question to us. Just for convenience of all the participants, my colleague is just pasting the answer over here, which we have received from the respective questions from Sarika ji. And if there is any further question, I would like to invite the audience to please raise your question. If not, then we will like to say thanks to our eminent speakers. Okay, there are two questions received, Samir ji. Let me just look into, and if you can answer, please.
Yeah.
So one question comes from Madhu Rathi. They have written, how do we recognize revenue for a long-term contract if there is a cancelable option in the contract?
Okay.
Yeah.
So it depends. The cancelable option in the contract is there, of course. It depends on who has the option. You have to take all facts and circumstances. If both parties have a cancelable option, for example, both can cancel at any time, then it's not even a contract. So you recognize only when the performance is done. The moment you do the performance, or you make whatever services you were providing, then it becomes a right to receive payment, and only then you can record revenue. But if both parties have a cancelable contract, it is not a non-cancelable right. It is not a contract on day one. But let's say one party has a cancelable right, which is the customer. In that case, then you have to look at what is the probability based on commercial. For example, I'll take a very simple example. You have you take a telephone connection. Now a customer has a cancelable right every month to not pay or not to cancel the connection. But because the customer paid a setup fees or a buying a SIM card or activation fees, or he bought a connected handset which will have to be either returned or the money will be lost for the customer when he bought the connection. So then basically the customer is expected to continue, and that is you will then take that into cognizance while determining the period of non-cancelable period for the contract. But of course, the facts and circumstances for specific things will have to be seen. I can't give a standard answer for which apply in all cases, but that's how you see it. You're on mute, Santoshji.
Yeah, Samirji, there is one more question coming from Mr. Jagundu Kar, and he writes, how to recognize revenue on claim raised to contractee by contractor and claim prepared and submitted to the contractee?
I'm not sure what kind of claim we are talking about. You're saying that a claim from the contractor to the contractee.
He writes, how to recognize revenue on claim raised to contractee by contractor. And then he writes, claim prepared and submitted to the contractee. How to qualify the same in notes to accounts?
Again, very specific question. I would not see claims. Are these claims part of the revenue contract or the obligations in the first place is what we need to see. Are these claims for defaults under the contract or things which could not go right in the contract, or are these for actually work done and claimed as done, or maybe escalation claims? I don't know which one we are talking about, but all of that revenue recognition will happen based on the fact that did you have a right to collect that revenue based on the contract. If you did, then yes, you will recognize the revenue the time you worked or you prepared the claim and gave it as per the contract. Technically, you should be doing it as you work because it's possibly be going to contractor-contractee sounds like a over the period of time contract, and technically you should be doing it over the period. The only challenge here is revenue is recognized when there's a right to receive payment established, or acceptance is also very relevant while we are talking about a contractor and contractee. So often you will see auditors not taking this argument that if you've raised a claim, that is good enough as a right to receive money for that. Acceptance is relevant. So when we talk about a point in time, or when we talk about transfer of control of goods or services, acceptance comes in as a very big part when we are talking about claims which are not readily accepted by other party unless it's discussed, goes to arbitration or wherever. So it will be recognized revenue. It should be recognized revenue as work is done, but it will depend on do you have a right to receive payment and is acceptance relevant.
Thank you, Samirji, for your answer. I hope the participants who raised the question would have got the answer from you. And in case further there is any question pertaining to 115 India's subject, and we would request to please write back to us, and we will connect you and pass on the question to Samirji, and you will definitely getting the answer on the subject. Further, I would like to apprise over here. Thanks to all the participants, both speakers Samirji and Sarikaji, who made this wonderful and enriching session. To all the participants, I am getting very good feedback in terms of what content has been covered and the number of questions, quality questions coming in that describes it themselves that how they are interested. And we look forward to many more such sessions on the subject. We are thankful to our partner who have joined this series on India's. They have supported us, the True and Fair network, Renew Power, SpiceJet, TCIL, Smart Bharat, the support that we received from Grant Thornton, and Bombay Stock Exchange Investor Protection Fund, technical partner being Majas, academic partner SRM University. We are thankful to all the participants for your being patient listening to this session, and look forward to other important such sessions which will be covering the important India's and they will address your questions on the subject. Look forward that you comply to the best of the requirements of the disclosures and meet the objectives of the good governance concept, the way that we, the accounting professionals, are supposed to be complying in our respective organizations. So thank you very much for being with us this long 2 hours session, and welcoming you in our further such engagements and outreach program in the time to come. Thank you very much. I'm thankful to my team who has supported us from the back end. Thank you very much. Thank you very much all. Thank you, Samir ji. And for the questions that we have received from audience to Sarika ji, the answers have been sent to the respective participants, and we will be further sending the answers through the email to all across, and we will be connecting with the speakers of the subject. Thank you.
Sure. Thank you.
Thank you. Thank you, Samir ji.